Hello, hello. Good morning, everyone. Good morning, YouTube. Good morning, Trade Pros. Happy Friday. It is the end of the week today. We have a decent bit of news. Next week, we have a little more news coming out. We have that CPI data that comes out next week. A lot of people are going to be looking at. But front and center this week has been the ECB and Europe. So a lot of energy talks have been going through Europe over the past few days. We had the ECB that came on yesterday, right? Talking about monetary policy and whatnot. We also had Jerome Powell pretty much reiterating what we already know. But the main focus is the ECB, and there's a lot out of Europe that is going to affect the general global economy, if you will, and a lot of even US markets and price action movement. So, in terms of Europe and energy, right, there's some energy ministers in Europe that are convening today in Brussels. As we have seen that the energy crisis continues to deepen and deepen, and it's shaking things up naturally. It's set to be discussed a series of emergency intervention measures to stave off runaway prices and more painful cuts that could result in a deindustrialization and even social unrest. So while these ministers will debate the effectiveness of the actions and their related consequence, a bigger part of the equation will be to maintain a consensus and preserve the unity of the European Union. So a few things on the table here. We have government support, and they're looking to prevent ballooning collateral requirements. Emergency credit lines would be offered to energy market participants that are facing high margin calls. We're also seeing rationing proposals that range from setting mandatory targets on reducing electricity consumption during peak hours to cutbacks in electricity utilization. We also have price caps. The most controversial of these measures is putting a price cap ceiling on the gas imported from Russia and how caps would affect different regions and different countries. And we also have trading suspensions. Caps may also be imposed on the margin limits that energy exchanges can ask for, or other temporary suspensions of European power market derivatives. We also have windfall revenues. Levels would be imposed on European electricity producers by setting a threshold at less than the current market rate and using the cash to help reduce household soaring energy bills. Now, again, like I've talked about this a decent bit, but I've seen a lot of the small businesses that have actually seen a massive explosion in their energy bills, and even people in Italy took to the streets just burning their energy bills in like buckets of fire, which was that goes to show what the impact is having on not only businesses, small businesses, but the consumer themselves. So we're also seeing we've also seen the role of the ECB, right, in all of this, because the ECB has been aggressively looking to tighten the monetary policy and hiking more aggressively, taking that more aggressive stance based on this energy situation, loading up the policy rifle with more gunpowder. The central bank delivered a monster 75 basis point increase yesterday, which was the largest hike that we've seen in the institution's 24-year history in total. So the cost of energy was the biggest factor in setting Eurozone inflation rates to 9.1% in August, which the central bank is trying to put a lid on and kind of subdue, like the Fed has been doing in the US on a more delayed basis, if you will. In terms of this transcript, we want all economic actors to understand that the ECB is serious. We expect to raise rates further because inflation remains too high and is likely to stay above our target for extended periods of time. This is what Christine Lagarde said yesterday. We think it will take several meetings. How many is several? It's probably more than two, including this one, but it's probably also going to be less than five, meaning that rate hikes could continue into early 2023 in the ECB. Lagarde also said, I cannot reduce the price of energy. I cannot convince the big players of the world to reduce gas prices. I cannot reform the electricity market. Monetary policy is not going to reduce the price of energy. The messaging leaves many to wonder about the role and strategy of the ECB, especially if it cannot fight structural energy issues and supply side problems. Rising borrowing costs will only increase the risk in the Eurozone, and that slide into the recession becomes more prominent. So the central bank has even sharply reduced growth projections for next year. Now, the global impact based on the ECB slipping into a recession is pretty drastic, right? Like, you're going to see those effects trickle all over, and especially with these energy prices continuing to soar, especially in the winter, you're going to see those effects into the US. Now, the US market is rising as if the CPI data came with a more subdued inflation number. Now, we've seen that the energy prices, in terms of oil prices themselves, have been slipping, which is going to contribute to a more subdued inflation reading, if you will, year over year. I think the number on the CPI will be lower than expected, which is probably going to propel some more of this weak buying upside. And another thing is hedge funds have the biggest hedges to the downside risk since 2008 on the overall market on the derivative side. So that's one thing that we have to consider as well, right? Naturally, these are hedge funds. I'm not saying are the be all and end all, right? It's not like institutional long money, right? They're hedging and they're speculating, so it's a little different than what you would see at other larger institutions. But they can easily get short squeezed, or this could be the greatest hedge of all time, right? We're going to see probably a max pay and a little more to the upside before we start to see a little more of a slip, and it's expected realistically. I don't think the bottom is in. And these energy prices, euro slipping under parity with the dollar, a lot of these things are putting downside pressure in the overall market, and they're going to put downside pressure in the economy, even in the US. So ultimately, government interventions are needed to shield energy users from some of the pain, but the ECB has to see to it that these price pressures do not get embedded, right? So this one of the Berenberg bank chief economists, right? They have to signal for workers and companies that the environment will be tough, and that they will not that this is not a backdrop for huge wage increases, which in turn would add to the inflation. The central bank, to make sure that the inflation expectations after the current surge in energy prices has run through the system, stay modest by sending a signal of front loading interest rates. So the continuous hikes in the ECB, right? Realistically, they are a bit behind the curve. The Fed has been doing it, and the Fed will continue to do so for quite some time, I believe. And we're starting to see that the ECB is picking that up, and that's just going to put similar pressures to the consumer end of things, just as the US has, right? We've seen that the mortgage rates have increased dramatically, right? Again, yesterday, I think Morgan Stanley posted 5.9 for the 30-year, which is massive, largest in like 30 years or 20 something years. They're going to put upside pressure on the debt levels on the consumers, right? The energy price are already doing a number on that. And a lot of this is spelling trouble for households, the consumer in general, as is in the US. So that's realistically what we're going to see propel a lot of this downside and potential recessionary action, not only in the ECB, but as well as in the US, right? So there's also another approach in the UK. They're dealing with a similar problem as the EU. Remember, they're not a part of the EU anymore, but is dealing with them alone. After Brexit vote, a formal departure of the bloc in 2020, new Prime Minister Liz Truss announced a new energy plan on Thursday to tackle the issues, shortly after taking up residence at 10 Downing Street. Not that that matters, but the country is also digesting the death of Queen Elizabeth II, blah, blah, blah. But the important aspect of this is there's a plan starting October 1st. The average UK household will pay no more than £2,500, which is $2,880 US per year for each of the next 2 years, resulting in £1,000 saving per year. A similar guarantee will be provided for businesses over the next 6 months, and with further support available for vulnerable industries like hospitality. In terms of the reactions, some constituents applauded the long-awaited relief, and others also wondered if they would pay it in the long term as taxpayers, right? So this realistically seems like one of those things where you're getting all this government relief for certain things, like we saw throughout COVID. There was checks distributed in North America, and realistically, the taxpayers are probably going to have to pay for that in the long term, right? Increasing tax rates. Also, you can see the adverse effects based on this massive balance sheet that we now have to unwind in the inflation measures. So will this propel the inflation further down the line? Probably. So it's going to be interesting to see how the UK deals with this by themselves rather than with the EU. And in more energy news, the gas prices in Europe are surging. Another energy source is going to the opposite direction, right? Crude oil, Brent crude as well. Brent is now under $90 a barrel. WTI, West Texas Intermediate, is under $85, which is nearly 10% below the level at which the benchmark traded before the Russian invasion of Ukraine. So Brent and WTI ended up hitting a high of around $130 a barrel during the crisis. And while the two are still up about 13% year to date, they have been on a very steady decline since about mid-June. So what's happening? The EU is the largest importer of natural gas in the world and has built much of its grid based on the fossil fuel. Natural gas is used for everything: cooking, heating for consumers, electricity, power generation for heavy industries. And the bloc used to be mostly resource independent back in the 60s and 70s, but North Sea gas fields have since been depleted. And while the bloc has reduced its dependence on coal and rejected investments in nuclear energy, which I think was a mistake, as a result, there has also been tremendous reliance on Russia, which has been threatening to cut off supplies completely and send benchmark Dutch TTF natural gas futures to the sky. So Brent and WTI oil, on the other hand, have highly linked to forces of the global economy, and those forces which at the beginning of the year were showing much promise due to the pandemic recovery have recently soured. So recession talks are everywhere, while demand concerns, rising stockpiles, China lockdowns, and the possibility of another release from the U.S. Strategic Petroleum Reserve are weighing on the prices. And in fact, crude is headed back-to-back weekly losses, down about 4% since Monday. So this is one of the things that will probably propel some of the CPI data to look flatter, aka better, aka more bullish, because if the energy prices are down, remember, you knock off about a percentage point on average, right? The rule of thumb year to year, based on a 10% drop in crude month over month basis. So we've declined very steadily in crude over the last month, and I think that is going to be a very big factor in the CPI data. But remember last time the CPI data, energy down 7.7%, while food and shelter was up about, I think, 7 to 13% in that range somewhere, the two of them. So a lot of the important consumer aspects, right? Of course, energy is one of them, but a lot of the day-to-day consumer readings based on the CPI data were actually continuously inflated. So you have to read into these inflation numbers. It's not just the CPI report, even though the market is probably going to react very well to a drop in year-over-year CPI. Now, to wrap this up and to take a look at what we should see in the market today, we've had a very steady rally here in the S&P 500 futures. I think they've already rolled over because, again, it's the end of the quarter this month. We're going to roll over probably next week in the futures. I'm just looking still at the September numbers. The volume's still higher. We've soared quite a bit, right? Yesterday, we had some volatility shakeout, but we managed to close above the 4,000 level, and now we're holding well above it. As long as we can hold 40.20 on the September futures on the ES, I think that there's a little more upside to come. If we can make that rally above that 40.40, 40.42, there's a big distribution block that opens up and can send us into 40.70 throughout the day. I'm still leaning a little more on the bullish side, but if you give weight to that 40.20, especially under 4,002, you're starting to pull this thing back, and 4,008, right? You're starting to pull this thing back, and you're starting to enter a distribution block back to the downside. So keep those areas in mind. I am leaning a little more bullish to end this week. Have a good weekend with a little strength in the market into the close. We'll see how that wraps up, but I hope everyone enjoys the day. Trade lightly. It's Friday. We don't have to break the bank here. We just have to keep whatever we made throughout the week. There has been some volatility, right? First week after Labor Day on a shortened week, and next week I'm expecting more volume, more volatility. So let's keep that going. Let's keep those trends going, and we'll be back next week. I hope everyone has an amazing weekend. We're going to open up those live trading rooms for futures and options, and we'll see you guys on Monday. Bye-bye, and take care.